Hello accounts people, time to have a look at Consolidated Statement of Financial Position. Consolidated Statement of Profit or Loss is a separate demonstration, as is some calculations on unrealised profits. That's items that have been sold between the groups and are still sitting in closing inventory. I am aware that on the AAT Level 4 exams for AQA 2016 there is a change to the workings out boxing, so I will show you both versions of the workings out boxes. There's only one that causes a big problem, the rest is fairly routine. Watch out for the terms: acquisition, retained earnings. Make sure you know what a non-controlling interest is, how to deal with revaluations and impairments, and have a quick look at the International Accounting Standard for associate companies, because we can consolidate an associate company if we have sufficient control over it, and also the two IFRSs. Quick hints: don't spend too much time talking before we get on with the numbers. Think of the group as a whole entity. Remember that retained earnings are a form of equity. We can of course have a bonus issue and turn retained earnings or revaluations into shares, and we can move them about. What's the timeline? Usually the acquisition is in the current financial year. It could be the first day of it, could be part way through of it. And then non-controlling interest, we treat them as a whole and assume they've always owned the shares throughout the year. Of course it could be a PLC as a subsidiary, in which case shares are being bought and sold on a regular basis. It could also be family members. The company, like Cadbury's or Sainsbury's, has been sold on to a big parent company, and family members have kept some of the shares. And this is the note, obviously workings out boxes for AQA 2016. Nothing else has changed, it's just the workings out boxes. The tasks then, so this is what's most likely to happen. You're going to have to calculate the goodwill, the difference between what we got and what we paid. Usually the first step, because it's the first row in the statement of financial position. You don't have to do it first, just most people do. Some items, well, not some items, most items, we're just going to add the two figures together, the subsidiary and the parent company. However, lots have to be adjusted for intergroup transactions. I can't loan myself money, and we're now thinking as a whole entity, so if there's a loan between the two companies in the non-current liabilities and non-current assets, that needs taking out. And also if there's been some sales and there's some money owed, receivables and payables would have to be reduced. But in this case we'll only see it as part of current assets and current liabilities. We won't see the breakdown. And if I was doing statement of profit or loss, I'd have to take off the sale. Other adjustments then, this is when the items that we sold are unsold. They're still sitting in closing inventory. We've got one of those in this question. Some items disappear. Share capital subsidiary and the premium disappears. It's been absorbed into the parent. And then we need to do some calculations on NCR. The latest version of AAT exam doesn't have all the workings out boxes for this, so you might have to do a bit of sketching out on a bit of paper. And then we'll need to adjust for revaluations, just to make it a more interesting question. We've walked into our subsidiary that we've just bought out and found out that non-current assets are worth more than their carrying value. That's a good bonus. But on the other hand, it might have been impairment. We've walked in and we're not very happy. We will, however, most likely impair goodwill. Unlike partnership goodwill, which is written down straight away, we can actually reduce over a number of years. Takes about 5 years usually. Onward with the question then. So it's borrowed from Kaplan, perfectly good examples in the other publishers. This here amount here then, the investment in Cat Limited, that's showing that it hasn't been consolidated yet. That's the clue, because it's still sat there. It's not an investment, they're now a subsidiary. So Kit are buying Cat. Fairly routine. Equity, liabilities, it's assets, it's pretty much routine. Notes are very important. These you have to follow and make sure you take a note of everything. This is just to tell you that the share value is £1 each, and hence the number of shares times £1 is the actual value. Apart from that, doesn't really mean much. This one, okay, this is the old-fashioned way of saying it. Kit Limited to 80% of the shares. What we're really interested is the fact that they have acquired control over 80% of the net assets of Cat Limited, and that's the date of acquisition as opposed to the financial statements date. And then the balance of retained earnings at acquisition, 540,000. That was bought, and then we're entitled to a share of what they've generated since. This is a revaluation. Property, plant and equipment worth an extra 900,000, and this is the intercompany transaction. £100,000 worth of goods that cost 60,000. Save you doing the maths, and then a quarter of that is still sitting in the closing inventory, and that's the goodwill we're going to do. So onward with the calculations. So this is a statement of financial position layout, but we're going to do some workings out first. We'll do this version of the workings out. We know we paid 2502, and we know what we got in terms of share capital. We got, and I'm putting the minus symbol in because we're just going to subtract it later, 1350 and 80%, or I could have done 80%, just 0.8 will do. And then we also got, at the time, 540. That was the retained earnings at the time, and we got a 0.8, 80% of that. And we also get the benefits from 80% of the revaluation of 900,000. So all in all, when we took the company over, we had goodwill of £270,000. Now the new version doesn't allow you to work that one out, so this impairment, was, we know it's going to be 20%. That's in the question. That on the new syllabus they've got to tell you this. 20% should be 54, which means the value that is going in to the financial statements is 216. So as I said, this is the box, the calculations, it's the biggest change, so it's worth getting used to both. Obviously very difficult for me, I've been doing this one for years, so I've got to adapt very quickly to the new version. So let's have a look then. So this is the workings out as it would be under AQA 2016. 2502 hasn't changed, we still paid the same amount of money, and we're still impairing by 54. They've had to tell us that one. However, what we're interested in, what was the company worth at acquisition date? We're not worried about the 80%. We're going to put the whole amount in. Well, 1200 plus 150 is 1350, but it's not the 920, it's the 540. So 1200 plus 150 plus 540. That's not right. Boo equals minus 1200. It is right. I just need to put some brackets around it. That's better. And we still got the revaluation, and that's not a problem. That's the same item. And now we're going to put in the value of the other people's. The non-controlling interest at acquisition. So it's the same 1890 at the point of acquisition, but they get 20% of it, so they still own 378. When we add it up, it comes to the same 216. Different way, same things. So that's done. So next one, property, plant and equipment. Quite often is just two added together. Listen to any instructions given or read any instructions given. That one's okay. Plus 2095. In this case, we've got the revaluation, the items that worth more money, and then we can add up our non-current assets. Inventories next then. So this will take a bit of working out, because although we've got two lots of inventories here, we've got some that's got the wrong value in our stock. So different ways of working it out. We've got a sale price, we sold it for 100,000. It cost 60, which means we've got a difference of 40. We sold 3/4 of it though, so equals and then if you make that a minus, we've got 10 to adjust it for. So our closing inventory and our unrealised profit is 10. Sometimes it's nice to work these things out logically, and what we've actually got sat on the shelf in our closing inventory is an item that is 1/4 of the 100,000 we paid it for it. So I'm going to take that one out. So 1/4 of the 100,000, £25,000 worth of items. We want to get rid of that and put in the correct value, which is 1/4 of the cost price from the group point of view, 1/4 of the 60,000. I need to reduce my profits by 10 and my closing inventory by 10. So inventories then will be the 4521 and the 642 minus the 10. Of course, it should really be 4521 plus 632. Trade receivables, this nice straightforward addition because I don't owe any money. This would have to be reduced if there was money owed for those items. But that's okay, that's the same. Cash is unlikely to be adjusted. Pretty much guarantee that will always be the same. Just add the two figures. Just watch out for overdrafts. So those add up to 8622, which means my total assets add up to 27743. That's the top half done. Equity and liabilities then. So we're only interested in the 1700, the share capital of the parent, and we're only interested in the share premium of the parent. However, this retained earnings is going to take a bit of calculating. There's a slight variation in the wording for AQA 2016. We'll have a look at that in a minute. So on the old system, parent. Right, the parent's retained earnings 19605, and then the subsidiaries. Now here we need to do the difference. 920 it says, but we take off the 10, the adjustment, and the 540 that it was when we bought it, because we're only interested in or entitled to a share of the earnings since taking them over. That hasn't worked out right, but it equals 920. Try putting the point in. 296, and then we're going to take off the impairment because that's coming out of our retained earnings. So our retained earnings will be 19847. So the 2016 version looks exactly the same and exactly the same numbers, but the labelling has changed. So Kit Limited's is 19605. The CAT attributable to Kit is the same, 296 that we've just worked out, and then the impairment is the same. So exactly the same numbers. There's room there for a other, you never know what might have happened, but here it's just the wording that's changed from the AQA 2013 version of it. So now we can put it in, and we can work out the equity of the parent. Now we've got to work out the value, because although the non-controlling interest own the subsidiary is part of the group, so they are part of the equity in the whole group. Now the workings out for this have disappeared off the new syllabus, but there are various ways of working it out. So, share capital and premium, how much do they own? Well, they still own 20%, 0.2 of the 1350 shares, capital and premium. They will actually get their full share of the 910, not the 920, because they've owned the company throughout. And they also get the benefit of the revaluation. Add that lot up, and that is the value of the non-controlling interest at statement of financial position date. They've owned it all the way through, so there's no need to worry about point of acquisition. It's just happened all that way through, so 632. So you need to understand that it isn't part of the new workings out layout, but it is part of the equity of the whole group. Long-term loans. Unless the loan is between the companies, we just add them together, and that's part of the non-current liabilities. And then again, if money was owed for the intercompany transactions, we wouldn't be adding them, we'd add them and then subtract. You can just add the payables together, and that's in the wrong place. It should have been there. And the taxation, companies are taxed separately, so there's no reason to do an intercompany transaction adjustment unless it tells you something in the notes. So 1082, those two added together, 4430, and hopefully when we add the equity, it will come to 27743, and there we are. So slight variations in the new workings out. No reason why you can't sketch out, but best to familiarise yourself with both. This is the more logical. This is what we paid, this is what we got, and it does allow you to work out goodwill at acquisition. The new version doesn't, but in some ways is simpler. But the end result is exactly the same.